Good morning, Las Vegas. Welcome to Mortgage Matters. I'm Roland Daniels, a certified mortgage advisor with Geneva Financial. And I'm here this morning, as always, with my fantastic co-host, Heidi Griffith. Good morning, Heidi.
Well, good morning, Roland.
Good morning.
So let's talk about some stuff.
Let's do it.
We've had a lot of conversations lately amongst ourselves about why people don't buy homes. You know, we talk a lot about, waiting for the interest rate. Last week we talked about, people waiting on the sidelines for the interest rate to come down. But a lot of folks that we work with, the biggest barriers to homeownership are money and credit.
Right. Those are the two largest barriers.
Yeah. So because the biggest barriers to homeownership are credit and money, are they the real barriers once you sit down and have a conversation?
Sometimes not. It could be just a matter of having the right information or actually starting the conversation.
Right. And you mentioned this last week on air, and you'd heard it just last week from a client that called you, and they wanted to work on their credit. They were in the process, and they'd mentioned that they needed to get it up to 720.
They had that 720 in their own minds of what they needed.
Right.
And I explained to the individual that you really don't need a 720. But
Not even
of course,
close.
No. But of course, we want you to have the highest credit scores possible, right?
Yeah.
But when it comes to the different down payment assistance programs, if that's something that you're interested in, minimum FICO score needed?
640.
640.
And we actually have programs that go lower than 640.
We do.
The reason why we don't talk about, let's talk about why we don't talk about those a lot. The Nevada Housing Division and Nevada Rural Housing, the way that they are designed is, again, here goes this catchphrase, to set people up to be successful.
Right.
To not put someone in a position where they're purchasing a home that at some point maybe they can't afford.
Right. They don't want you to go using over half of your income towards the mortgage, because that doesn't leave too much left for everything else, right?
Right. And they've done a lot of studies around credit and what people's tendencies are, depending on where they are with credit, where they are with finance, all of that kind of stuff. And they want to make sure that it's not a roadblock. It's there so that you can take the steps necessary to get where you need to be. And a lot of bad information about what credit scores should look like.
Right.
And a lot of information out there as to where to find your credit scores that might not directly align with a mortgage credit score, because that could be different than, if you're going to go get an automobile, or
that is true.
If you're looking at credit cards, because all of these different industries have different scoring models.
They do. Anywhere from, we have mortgage scores, we have regular consumer scores. We have, I think right now, there are over 5 different scoring models if you're looking to purchase an auto.
And more coming forward.
Yes, it is.
We've heard news about a bunch of different models and maybe switching the mortgage. Right now we use a FICO model.
Yep.
If you use Credit Karma or Credit Sesame or those kind of things, those are traditionally Vantage scores.
Vantage scores, which was created by the 3 bureaus, but they haven't been adopted by the mortgage industry yet.
Right. And so there was talk about that at the beginning of the year, that we were going to go to Vantage scores. That has not happened.
Nope. Still using FICO.
And I don't know if it would be a benefit to the consumer or not. We've done some research. It's hard to say right now because we don't know exactly what that would look like.
Well, we don't know what those scoring models are actually going to, like you said, what are they going to look like? What are they going to focus on? We don't know.
Right.
They tell us, but we actually don't know.
Right. So it should be interesting to see how that plays out moving forward.
I agree.
But right now we use a FICO model. We use what's called a tri-merge report. We pull all 3 bureaus' scores. So that's going to be Experian, Equifax, and TransUnion.
Correct.
And let's just clear up some misconception on this. When you're purchasing, if you're one person, we're using your middle score as your qualifying score, because all 3 bureaus are going to have different scores.
They do.
They might be close. Sometimes they're off by quite a bit.
Right. Sometimes they're off by 30 or 40 points.
And it just really depends on how your credit is being reported, how your credit card companies are reporting, and if they're reporting to all bureaus or one bureau or whatever that looks like, student loans, all of that good stuff. If you have an auto loan, maybe they report to all 3, maybe they don't.
Right.
So you're going to have different scores on all 3 models. We use the middle score. If you're purchasing with, say, a spouse or a sibling or a friend or multiple people, maybe there's 3 or 4 of you that are purchasing a property together.
Which is possible.
We don't average scores.
We do not.
We use the middle lowest score.
for all of the borrowers on the application.
Right. So whoever's the lowest middle score, that's the score that you use to qualify. So that people get a little confused with that.
They do.
And so that I think that's a great tip. So, but credit and money, those are the things, right? So is my credit good enough? We have resources to help. We have free resources to help with credit. We have down payment assistance programs, and we'll talk about that probably at some point today on how we can get those to work. But I kind of feel like the biggest reason people don't buy isn't credit or money.
Most of the time they get stuck.
I think that they never find out where they stand.
Yes.
We make assumptions about ourselves. Sometimes
all of the time.
We create scenarios in our head and we go with it because it sounds right.
Right. Or maybe we've heard from what I call the street committee
you do.
from people such as a coworker or a family member. Maybe they've never even purchased a home.
Or they purchased 10 years ago or 5 years ago.
Right.
Or they used a different program or they had, X amount down. Nobody's scenario is ever the same. If you and I went out and bought homes
it will
simultaneously
look different.
Tomorrow, it's going to be complete. Our situations aren't the same.
Yep.
So, and you do call them the street committee.
I do.
And, everybody has opinions, and I really believe that everybody's trying to look out for your best interest. But if they don't know your scenario and they don't do this every day, how can they really protect your best interest?
True.
Right? I'm not saying just go all willy-nilly. You want to have guidance and support and all of those good things. But a lot of times you're getting bad information.
Yes.
You don't need to have a 720.
Or maybe that information hasn't been updated. Maybe you're using old information.
Well,
right?
Information changes, it feels like
all the time.
Every minute.
Yes.
It's just always changing, right? So again, the biggest reason people don't buy isn't credit or money. It's that they never really find out where they are.
And it starts with just one simple conversation.
It does.
Do you agree?
It does. Because we talked about it on the last show. People are waiting on the sidelines for rates to come down.
Well, we hear it all the time, waiting for prices to come down, right?
We're waiting for the market to crash.
Yes.
And I'm not saying we don't need a correction because our values, as they continue to rise, that affordability gets farther and farther away. But there are no indications.
I don't have that crystal ball, but I do not see the real estate market crashing.
There are no indications. We were actually at a housing forum with Nevada realtors this week.
Yes.
And they made some great points. They made some really great points. But when they were talking about the current state of Southern Nevada real estate, they had pointed out that we're in a flat market. And I tend to agree with them. And, our market we have a bunch of sub-markets in our market.
We do.
You can't blanket say this is how the real estate market in the Valley is because, number one, we know luxury, $1 million plus is going bonkers.
It is.
It's crazy. It's increasing. People are buying $1 million plus homes.
They are.
Is that great? I guess if you have $1 million to buy a home, it's great.
Right.
For a lot of us in the Valley, does that drive prices up? Are we bringing in more money? We know a lot of people are moving from other states. We have no state income tax.
True.
The same.
A lot of people from California.
Yeah. The same group with the Nevada realtors at this forum was talking about bringing in, businesses that pay higher wages.
Right.
Which, again, phenomenal. Come on, let's pay people more. People deserve to get paid more. But does that help
the existing?
I don't know. It's a great question. But I guess we're going to find out.
We will.
I guess we're going to find out. But are we helping the people that need help? Are we helping people? And that's why we look at the programs that we work with, isn't it?
It is.
It is. So I guess the best piece of advice I could give if I was going to give somebody is stop making assumptions. And maybe it isn't time.
Right.
But stop making assumptions because I feel like knowledge is power. It's best to know where you are. There is no commitment to find out
right.
what that looks like and what your path forward looks like because until you take a first step in anything, you can't move forward.
True. Because people are still saying that before I move forward, like you were saying, I need to pay everything off. I'll reach out when I'm ready. Let me fix credit on my own.
Or even I'm going to call somebody.
Such and such.
And I'm not saying that you shouldn't do it on your own because it's everything that we're talking about is doable on your own.
True.
But with a little guidance, it makes it a lot easier.
Well, when you have professionals that actually do this for a living, it makes things a little bit easier, such as a HUD counselor, right?
HUD counselors, lenders. A lot of times, again, we're making assumptions. Maybe you haven't even checked your credit. I don't know how many times I've talked to somebody and they've said, oh, it's going to be bad.
Right.
And, they close their eyes. They peek between their fingers when they're talking.
And then they have a 685.
And then they're doing great. They're doing
Yes.
great. We actually closed a transaction just yesterday.
We did.
And she had done the right things. She got with someone who knew what she needed to work towards.
Right.
She built her credit from the mid 500s to the high, just right under 700
Right.
in 2 years.
Yep.
And she closed on a home yesterday.
She did.
And I mean, it's a magical story. I think we should talk about those numbers in just a little bit. But
We
just
will.
understand, if you're trying to go it alone and you never know when you're ready, you're not getting told no, because you're not even giving yourself the opportunity to be told no, you can't do it, right?
Right.
You just never find out that the answer might just be yes.
I agree with.
And, unfortunately, like we talked about last week, this is kind of where people lose time. Again, people are waiting on the sidelines. There is pent-up demand in the real estate market on a national level.
And what happens when everybody hits the market at the same time?
And that's what we said, when people jump back into that market, whenever that phantom rate that everybody's waiting for pops up, do prices go up? Are we then again in a situation where prices shoot up and now things are out of reach?
Right. Because like I tell everybody, or the clients or I speak to, I said the market is always right. It's not me or not you or social media. It's the market.
Oh, absolutely. And that's why we always say our crystal ball is broken. Because, back in the, I'm going to age myself. Here we go. Back in the 90s in real estate,
Right.
I got licensed in 1997. So back in the 90s in real estate, there was a lot of indicators. You could look at the indicators and kind of have a good grasp on what was going to happen the year ahead.
Right. History was important.
It was. And now there's just a lot more variables.
Yes.
There's a heck of a lot more variables.
Things
now.
have definitely changed.
And we saw it happen, coming out of COVID when we had those super low interest rates. Will that happen again? Probably not. Will the rates be there again? Probably not. Again, I'll say it one more time. If we see those 2.5% and 3.5% rates, I wouldn't be dancing. I would not be dancing, and that's because something bigger
is happening at the moment.
And it's probably not fantastic.
Right. And you're not going to be worried about those low interest rates.
Yeah. So, it takes the average person 7 years to save up for their down payment.
That's a long time.
And, if we're just getting started in that path, what does that look like in 7 years? Or even if maybe you have a windfall, maybe a lump of money falls through your ceiling.
Right.
What does that look like 2 years from now, 3 years from now?
A lot can happen within that 7-year period of time. Imagine, appreciation.
Well,
on
shoot,
a normal
we saw it,
3 to 5% is average. During 2020 and 2021, our appreciation rate was over 20%.
High double digits.
Right?
High double digits, yeah.
So imagine all of the appreciation, and you're still paying those 7 years of rent, which goes to the landlord and not paying your own mortgage.
So just a lot of things to think about. Barriers to homeownership, money and credit. So what if you're, if you had your down payment available, minimum down payment we'll go with an FHA loan. With an FHA loan is 3.5%. It's not 20%.
Nope.
3.5%.
That is a myth that you need 20% down.
Oh, it's a big myth. It's a big myth. Hopefully everybody listening today doesn't believe that myth anymore. Hopefully we're starting to clear that one up. 3.5% is minimum with FHA. With conventional, in a lot of instances, you can go as low as 3%. With VA, it's not $1 down.
It's
no down
zero
payment.
down.
But with all of that, right, you still got to save for that 3.5%. And maybe you don't have it, right? So you're working to save it. Maybe you still have some credit stuff that you've pulled your credit on Experian.com. That's a good place to look at your credit. Remember, everything that you're going to see online, unless you're paying for upgraded services, and I don't think that's necessary.
No, it's going to be your consumer FICO Score 8 model at Experian.com.
Right. And a lot of times I know Wells Fargo uses a FICO model.
Wells Fargo actually uses a FICO score 9.
Right.
The score is a little bit lower than the FICO score 8 model.
And I think it
But
really just depends on
close.
your profile, because a lot of times my Wells Fargo, my credit score actually tends to be higher than my FICO 8, but it just depends on what's going on, when I've paid my credit cards in that billing cycle, all of that kind of stuff.
Right.
You don't need to be worried about 2 or 3 points. I mean, we're trying to keep you, because it's going to go up and down every single month. It's, you're going to see some dips, you're going to see some credit score boosts.
And while you're talking about credit reports, we just want to make sure that for the lending process, there will be a hard credit report or a hard credit that will hit your report. And it'll be about 5 points, but you'll get those 5 points back in a few months.
Absolutely. And it also, and the way that the credit reporting agencies and bureaus look at it is just like kind of when you go get a car.
Yep.
Very similar. So they understand that you as a consumer should shop.
Right. And you're looking at other lenders.
And you look at other lenders. You go to a car dealership. Maybe you're looking at other lenders for your, auto loan.
Right.
There's kind of a grace period window that they allow. So the first time your credit's pulled is that hard pull. That's where you're going to feel the hit. And sometimes it's 5 points. Again, depends on your profile. Sometimes it's more than 5 points.
And sometimes it's less.
And sometimes it's less, right? But it should not be enough that it's impacting your ability to get credit.
Right.
Now, your credit could be impacting the ability to get credit.
That is true.
But getting your credit pulled should not impact the ability to get credit. And then as you look at other lenders and look at other options during that time period, those subsequent credit pulls aren't affected.
Right.
Now, if you shopped today for something and then a month from now you shopped, you would probably
get hit again. Yes.
Not necessarily, but just understand that the risk is there. They think that if you're out purchasing something, a car, you're going to be looking within, a couple week period as you go car shopping.
Right.
So let's go back to credit really quickly, because we're kind of all over the place, but I think that it's just great information.
It is. It's great information.
And when we're talking about your own credit, right, you don't have to spend a lot of money to fix your credit. Actually, I don't suggest spending any money to fix your credit, especially if you're fixing your credit to do something that needs money, right?
Right.
And we'll in this situation call it purchase a home. You want to buy a house. So you want to get your credit ready to purchase a home. And maybe you want to utilize, a down payment assistance program. And
which means your down payment is covered.
Is covered. And in so many instances, a little bit more. So towards your closing costs could be potentially covered. But when you're getting there, like we said, Nevada Housing, Nevada Rural, their minimum credit score is 640.
Right.
Now, if you're sitting at 610, that doesn't mean no. It does not mean no. Actually, 610 to 640 could be a relatively easy, relatively short period fix.
Yeah, maybe 30 to 60 days.
And actually, those tend to be the hardest for, an individual to try and balance, because we actually have AI tools available that we can look at a credit report. And if it's just, 20, 25, even 30 points.
Yeah, we can give you a plan.
We can actually set it up, and it will tell us.
What you need to do.
It won't say pay off your Chase card in so many instances. It will say pay the Chase card down by $37.50,
right,
or pay the this off completely,
Yep,
and it's really fine tuned, because your credit really is this really fine tuned scoring system.
It is.
And if it's more than that, because life's.
It is.
No judgment. We look at credit reports every single day. I have been at the bottom in my lifetime. I have built my credit back up.
Right.
And I got to tell you, when you build it up, boy, are you proud.
It feels good.
Oh boy, does it. Well, too, right?
I do.
Yeah. I mean, that's such a sense of accomplishment. But if you're in a position where you need a little bit more help, there are free resources available. These are HUD certified counselors. We work with CPLC. We've been sending our clients to them for about the past almost 6 years now.
Almost 6 years.
Almost 6. But there's several in the Valley. How many HUD certified credit counseling agencies?
I think there is 5 right here in Nevada, actually, 5 or 6.
And they'll all do credit counseling with you.
I'm pretty sure.
So there are free resources available. if you do, or you know someone who does credit repair, this isn't a dig. But there are free resources. And we've just met with so many people who started a plan with a credit repair company, and they paid them $200, $500, whatever they had to pay up front.
Some over $2,000.
And then there's a monthly fee in most instances.
Yes.
And my brain goes like this. How are they going to do this fast if we're paying them every single month? They're making income every single month. And that doesn't mean that they're all going to do that.
Right.
There are great people in the world that are really trying to help us. So at the end of the day, people don't miss out because they can't buy.
Right.
They miss out because they waited based on assumption that they possibly made that might not have been true. So when you have a conversation,
right,
you start. You take the first step. And taking the first step is how you move forward.
We'll be back next Sunday morning at 7:30 a.m. right here on KUNV 91.5. Until then, believe in what's possible, even if you've been told that it's out of reach. And remember, stay true to yourself and your mind.
Bye.